Hey there, ever been tempted to spend every free weekend at your short term rental? Because after all, it's yours. It feels right. You own the place, you should enjoy it. But if you're not careful, those weekend getaways can turn your tax saving investment into a financial sinkhole. So let's make sure that doesn't happen. I'm Samy Basta, your go-to real estate accountant, and today we're talking about something called the 14-day rule or Augusta Rule. It sounds obscure, but trust me, this rule separates savvy investors from expensive mistakes. Here's the basics. If you own a short-term rental, the IRS only lets you enjoy it for personal use up to a certain limit. That limit is the greater of 14 days or 10% of the days you rent it out. So let's say if you rent your place for 160 days, you get 16 personal days. If you rent it for 200 days, you get 20 personal days. Cross that line, and the IRS no longer sees it as a business. It's your vacation home now, and most of your juicy tax benefits go out of the window. Personal days isn't just when you stay there yourself. So if your friends or family stay for free or at a discount, that counts too. Even if you charge your cousin something, if it isn't a full market rent, you've used personal days. And swapping houses with another owner, that's also considered personal days, whether or not any money change hands. The IRS looks at who's using it and what they pay. So if it's family and they're not moving in for good, it's personal. On the flip side, there are some helpful exceptions. So if you're at the property to work, repairing, painting, deep cleaning, for example, you can ignore those days. So to be safe, the full workday benchmark is around 4 to 6 hours of actual work. So let's say you spend a day fixing a roof. That's maintenance. If you fix a faucet for 30 minutes and then spend the afternoon on the beach, that's vacation. So travel days also can be excluded if the main purpose of the trip is maintenance. But again, it's all about the dominant purpose of your trip. So if most of the trip is business, it's a business trip. If you vacation most of the trip, it's a personal trip. Now, let's talk about record keeping because that's what the IRS is looking for. The IRS works off evidence. So if it's not written down, it might as well not exist. Keep a log of every stay, who was there, why they were there, and how many hours you worked or the owner worked. If it was maintenance, it was repair, it was painting, even a simple spreadsheet or shared calendar works. It protects you. In one famous case, an investor kept meticulous logs, and when the IRS challenged those deductions, those logs saved the day. So they proved that maintenance trips were legit work, not fake vacation. This isn't for big landlords. Even a single Airbnb can benefit from those rules, but you need to treat it like a business. So talk to your family and friends. Be clear about those rules. It might feel awkward to say, hey guys, sorry, I can't let you stay for free, but you're protecting your business. So charge fair market rent, keep personal days and stays under your limit. So set boundaries now so you're not scrambling during tax season. One more thing, local regulations are separate from the 14 days rule. Some cities require you to be on site or limit the number of days you can rent out your place. The 14-day rule is a federal tax law. So local laws are another layer. So learn both so you stay compliant everywhere. And remember, following the rule makes your finances cleaner. Lender like seeing a well-run business when you apply for new mortgages or refinances. If you love staying at your rental and 14 days rule isn't enough, consider other strategies. Like, for example, you could switch to midterm rentals, 30 days or more, which have different rules. Or simply buy another vacation home just for yourself and keep one property purely as business. Either way, the key is planning. So here's the takeaway: know the limit, 14 days or 10% rental days. Track your time, respect the line between business and personal, keep your records tight. If you follow these simple steps, you can enjoy your property and still enjoy the tax benefit that come with it for being smart short-term rental owner. We're just getting started with powerful tips like this. So in our next video, I'll dive into bonus depreciation, another way to put thousands back into your pocket in 1 year. So hit subscribe, turn on notification so you don't miss it. You're not just investing in property, you're investing in knowledge, because knowledge is power. I want to thank you so much for your time. I'll see you on the next one.
This has been another episode of our tax-saving video series. If you enjoyed this video, please like it, subscribe below, and share with other business owners. You can find previous episodes and more information at www.bastacpa.com. Thanks for listening, and have a great day.